Another 10. $32,000 of boot on this one. It's going to be $32,000 of taxable gain that they're going to have to pay. This is unbelievable. Hey there, Neil CPA here, bringing you another episode on the basics of 1031 exchanges, but then actually spend some time on the most common pitfalls I've seen from a CPA's perspective. So things that just happen over and over again after you've structured a 1031 exchange perfectly. So stick around if you're interested in hearing about the most common pitfalls around a 1031 exchange and how to avoid them. Basics of a 1031 exchange. We are usually looking at doing a 1031 exchange when we're selling an investment or business property. The most common examples I see of this is the sale of commercial or residential rental properties. Most importantly, you cannot sell your property and take possession of those sale proceeds. They must stay in escrow with the facilitator. Number 2, you only have 45 days to identify a replacement property from the date of close on your relinquished property. Number 3, you only have 180 days in total. So from the date you sold and closed on your relinquished property to the date you purchased and closed on your replacement property, 180 days. 180 days, no extensions, no ifs, ands, or buts. Fourth thing, if your desire is to defer 100% of your taxable gain, you need to purchase a property that is either equal to or greater than the sale price of your relinquished property. There's a little room in there for the sale of your relinquished property and purchase of your replacement property. But good rule of thumb is if you're selling for $100,000, you should be buying something that's at least $100,000 if your goal is to defer 100% of all taxable gain. That's the part of this video I want to dedicate to the basics of 1031 exchanges. There's tons of videos out there on the basics. What I really want to cover in this video is just the most common pitfalls, the things I see over and over again that create taxable gain, even if you bought a property that's 3 times as much as the property you sold. Pitfall number 1, cash out loans in the same escrow as the escrow you're using to buy your replacement property. This is a rookie mistake 101. I don't know how facilitators in good conscience let this happen. They don't hit the timeout button. You cannot take cash out of an escrow and expect to have no taxable gain. It's considered boot. Neil, what if I refinance it? Isn't that the same as taking cash out? Why does the IRS care? Tax code is written and approved and enacted by Congress. And it's just the rules. Is it silly? Yes. If I could change these rules, would I? Yes. But can I or can any of your CPA or tax professional folks out there change these rules? No. So do not take cash out of your escrow unless you're expecting to have some taxable gain. Pitfall number 2. Prepaids transferred to your relinquished property's new owner. The prepaids I'm talking about are things like prepaid property taxes, tenant deposits, and prorated tenant rents. You're probably thinking, how or why is that boot? It becomes boot because your facilitator is just not that sharp. I don't know. I don't know why they don't call up and say, hey, do you want to write a check to the new owner for the prorated rents? If you don't do this, it will create boot. They don't, though. They just don't. They don't do this with the property taxes. They're so used to closing transactions day in and day out that their plan, when they sell your property for you and get to the closing table, they're going to calculate how many days of rent have been prepaid and need to be transferred. They're going to calculate how much of the property taxes you owe or, that need to be transferred to the, lost my train of thought there. Anyways, yeah, so my experience with this is the facilitator is an escrow company and they don't really treat escrows a whole lot differently when it's a 1031 exchange or just a normal sale. So they're very used to calculating the proration of property taxes, the proration of prepaid rents, and transferring tenant deposits in escrow. And so they just do it. The problem with this is that's all money that is going from your proceeds, the proceeds of your sale. That's all money getting taken from the proceeds of your sale and being transferred out of escrow to your buyer for not like property, i.e. those monies that are going out are not for real property. They're for other things that we've covered. Pitfall number 3, early loan payoff penalties and prorated interest. This is really common when you're selling a property that still has a loan on it. Early loan payoff penalties, I usually only see these on commercial loans. So if you're an active investor and you're using less than conventional loan sources, your loan documents could very well have early loan payoff penalties in them as well. Early loan payoff penalties and prorated interest expense represent boot. Escrow is going to take money from the sale of your relinquished property and transfer it out for non-like property. Early loan payoff penalties, interest expense. So in summary, pitfall number 1, cash out loans in the same escrow. Pitfall number 2, prepaids transferred to your relinquished property's new owner. Pitfall number 3, early loan payoff penalties or prorated interest expense. All right, we've covered the basics of a 1031 exchange and the 3 most common pitfalls I see that create taxable boot, other than just failing at the basics of a 1031 exchange, i.e. not buying a property that cost enough, not identifying a replacement property in 45 days, or just failing to close on purchasing that replacement property within the total 180 days allowed. Solution time. Pitfall number 1, cash out loans. Easy solution. Don't do it. Refinance 30 days, 60 days, 90 days later. Just don't do it. For pitfall number 2 and pitfall number 3, identify these on those escrow summaries that get sent out. You generally will receive cost to seller, cost to buyer, estimated statements from escrow, and they should be identifying prorated rents, estimated prorated rents going to the buyer, credits for property taxes going to the buyer, and then early loan payoff penalties. Hopefully you as the investor are aware of this clause is there, so you can kind of be thinking after watching this video, I need to tackle that. The way we tackle this is simple. We write a check to escrow before we close on the sale of our relinquished property. We write a check. This then covers the idea of settling boot at one closing table. So we're closing on our relinquished property with boot items going out, but we contribute boot by writing that check and we get out of recognizing taxable gain. We've cured this by putting cash in before close on the sale of our property. Navigating 1031 exchanges can get kind of weird, kind of fast. The best thing you can do is when you get into escrow, or maybe even before you put your properties up for sale, is to contact your tax professional and walk through what it is you're thinking about doing. Verify your adjusted basis, verify you don't have a bunch of suspended passive carryover losses that would just make doing a 1031 exchange silly in the first place. These are great conversations to have before you're like fully committed to getting into the 1031 exchange process. Again, if you've enjoyed this video, like and subscribe. If you have a more specific question after watching this video, use the comments below. I'll do my best to give you an answer as quickly as I'm able. Remember, every explorer needs a map and a guide, so consult with your CPA, that's me, to make the journey less daunting. Well, that's it. I got you through the basics of a 1031 exchange. I told you about the most common boot tax gain pitfalls I've seen over and over again. They happen in almost every single 1031 exchange I see that I didn't have an opportunity to talk to my client about prior to. So don't feel too bad if it's happened to you. I hope you have a better understanding of why it happened and you can avoid it in the future. Until next time, remember to plan your exchange so you're not left with the pain of taxable gains. Thanks.